place I've ever been.
Hello guys, welcome back to another Lumley trading video. This one's going to be a relatively quick one, but it's on how you can use standard deviations on a swing time basis. I've gone through a lot of day trading and my recaps are always day trading recaps, but I've had a question. I'll put it on the screen now, so shout out to him for asking how you can use the deviations on a swing time frame. So we'll be going over it with an actual example that I traded myself, and that's on Credit Suisse. So again, you kind of look for the same things you are when you're day trading. So you want to go over to the long time frames. You don't really care about the daily ones, like the 1 day 1 minute as much if you're looking for a swing trade. However, so Credit Suisse I think was a great trade. So how I trade it, my swing on this one is a more of a long-term basis. So it's not like a week. I'm not trading it over a week, and it's probably going to be more of a few months trade. So as you probably saw, one of the hedge funds a lot of the banks were invested into got margin called, and yeah, basically just lost quite a lot. They got margin called, they lost money, and so some of the banks also lost their investment, or a majority of their investment in it, so it created big losses for them. However, you can see here Credit Suisse, it got announced and it fell roughly 10% on a bank stock. The loss they took from this did not devalue their company by 10% or anywhere near that. So to me, this was just a over exaggerated sell-off. But that allows me then to see good buy zones using these deviations. So you can see we faded into these deviations on kind of both here. We've kind of got a small bounce now off the second deviation by about 50 cents. But this is more of a buy zone. So on these longer time frames, I don't exactly use them as exact buy points because I tend to trade options. But they do allow me to find good strike prices. So you could obviously buy stocks as it comes into the deviations, but I'm going to go through how I trade them because, why would I? I can't really recommend something that I personally wouldn't do myself. So with Credit Suisse, I ended up going to sell cash secure puts, I think for like September or a relatively late expiry. I think it could have been September. And basically I just went over and sold $10 cash secure puts. So you can see here right now, if I was to do it, I would make around $60 to $65 per contract I sold. I think I sold 8. So yeah, we'd be making around $500 in premium to sell those 8 contracts, or maybe a bit less, like $440 or so. And then basically what I would do is that saying you'll buy the Credit Suisse no matter what at $10, even if Credit Suisse is below $10. So if Credit Suisse was at $8, you are still saying you'll pay $10 per share for them come to the time of expiry. However, I don't think Credit Suisse is going to be that low, especially in 6 months down the line. So I sell these cash secure puts. I keep a premium, in this case, around $450. And then it means if Credit Suisse goes up and stays above $10, I keep that premium and I don't even have to own the stock. However, if it falls down, I then own the stock. But that's at the time of expiry. So let's say I bought the September expiries. That means if it comes to the 17th of September, and let's say Credit Suisse is $9.50, I'm then buying the stock at $10, even though it's worth 50 cents less per share. However, I'm actually still making money because, as you would have seen, I got paid premium. So I got paid, let's say, a minimum of $60 per contract. So that meant even if I bought the stock at $9.40, if the stock was at $9.40 when I bought it for $10, I'm still breaking even. So basically, this from here, if I was to buy it today, if the stock price is above here, or anywhere above here, I'm making money. If it's below, then I'm in the red. However, you can see if it came down that low, I'm coming into this last deviation of Credit Suisse, and it did have a bit more room to go on the daily. But this is a way I like to trade them, because trading them all the way down at the green deviation or the third deviation is not always the best, because then you don't really have zones where you're looking for, because you're already kind of like at a good value. However, if I do this at the second deviation, I get relatively high premium prices while also allowing targets for like low targets. How I don't think it's going to go this low, but if it did, I'm still happy to own it at that price. So even if I own the stock, if I got filled, I would be happy to own Credit Suisse at that price. So that's the main thing I'm looking for. But then you'll also know I waited for this massive gap and news. The reason I wait for this news is with options you get implied volatility. When implied volatility is up, premium options go up, or option premiums go up. So that either means, let's say 2 months down the line, the stock's still at the same value, it's around $10.70. My options I would have actually still made money on because the implied volatility would be super low by then, most likely. So I could just sell them back. I no longer have any contracts or any options, but I've made money. So that's the main way I trade them, through options, trading kind of news with technicals. So that's how I personally like to do them, to kind of trade them after a big news hit into a deviation, and then have a strike price where I kind of break even around the lower deviation. So the only thing with this strategy is it's kind of harder to find stocks. So the way I usually do it is I don't swing trade all that much, but when I do, I wait for big news hits. So like Credit Suisse, that was a relatively big news article. Well, the hedge fund margin call was relatively big. I saw one of the biggest hit being Credit Suisse, so that's when I went to go and trade. However, you could always just go and look through the key stocks, you know, like AAPL, Apple, and all these kind of stocks. You kind of just wait for news, and maybe like a callback. So like if you were maybe to trade Apple, you can see Apple never really trades outside of these this first deviation on either side all that much. It only really traded outside of it there, and again small areas here. So with something like Apple, where it's more of a solid stock, you don't really need the news hit. You more likely can just trade it as it comes into the deviation. So you know, if Apple pulls back to around the 120, the 125 area, you could maybe sell some cash secure puts at 115. You get relatively high premium. If it falls that low, you can buy the stock. However, me trading like that, you need the money to be able to buy the stock. So if I was to do it on Apple at the strike price of $115, I need $10,000 or $11,500 per contract I sell. That's why you may want to do it with shares and just buy them when it comes into these areas, and you can do it the exact same way. I just like doing it with options because you kind of leverage the amount of money you have, and then I don't really have to own all the stock at one time. However, yeah, if Apple pulls back to this 120 area, it just gives you a good indication that it could be a good time to maybe buy it, and you can hold it for, you know, a price target of 130, 140, or whatever you're looking for. And again, the swing strategy is the same kind of thing as the investment strategy. You would have seen when I made the videos when the market was correcting on both SPY and Nasdaq. We were waiting for this pullback. You can see it literally came into this deviation, this big pullback here. Everyone was getting worried. I was waiting to add to my position when it pulled back this 11%, because here it was coming into the deviation. And again, these big indexes, these solid stocks, don't really trade outside these first deviations. So buying them at these deviations is a great starting point, whether you go full size there or you want to average in. So you'll see it came up here, pulled back a bit, and then, you know, we've gone up to new all-time highs just by waiting for the bounce off the deviation. So basically, I hope that kind of makes sense. You're basically, depending on the kind of stocks you trade, you kind of trade them differently. So personally, I'll give you like a quick summary. If it's maybe not a so solid stock, one maybe with a smaller market cap, and not as reliable, you probably want to get a news hit, but a company that you still believe in, where if it gets hit by this news article, it gets hit relatively hard, pulls back 5, 10, 15%, you're still happy to own the stock, just in case, you know, it carries on going against you. However, with these more solid stocks, Apple, the indexes and all that, you can just relatively buy them into these standard deviations. You don't really need to wait for news, because you can trade these off technicals and they'll respect it relatively well. I'll go over one more trade real quickly because I did take it. If you follow me on Instagram, you would have seen it, and that was Visa. They got hit massively. I think they went down 6% in one day. So it was around this area to here. You can see, yeah, 6 to 7% in one day. On this day here, I sold cash secure puts. Reason for it is, I think I ended up sending like 2 to 5 contracts, and they were big premiums. I think I made $2,000 or so in premiums. Reason for this was because we were coming into these deviations. There was a relatively big news hit. Visa getting hit 7% in one day, not really reasonable over the news it was. Don't know if I can find it now. I think it was something to do with people saying they were getting charged a bit more, like the Visa fee went up a tiny bit or something, or was more than it should have been. I did a cash secure put. I did a relatively high strike. I think my strike was 205, which is a bit more risky. Should have been doing it around like 195 if you want to be conservative. Obviously premium wouldn't be as high, but there's less risk associated with that trade. So this position now is up relatively high, and you can kind of see we're already pushing up to all-time highs. We'll probably be there in the next few days. And again, Visa is one of those stocks where you don't always need the news. Like this one, you could kind of trade off technicals. Maybe not as ideal because it doesn't respect this first deviation band, but if you want to trade off the second ones, it gets respected a lot more. And if you're looking on the 4 hour, the third deviation band. But yeah, so you'll have to kind of go through these stocks. You can also, if you're using, well, you will be using most likely Think or Swim. If you're using these deviation bands, you can always use On Demand. Go and test back these stocks, go back in time and see if they're respecting what deviation bands they're respecting in real-time data. And that's basically what you need to look for. Again, Visa is not one you would have had to wait for news. The news just made it more likely for it to get a sharper bounce as it did here. You know, crept and then nearly fully recovered in, I think that's less than a month. So yeah, I hope that helps. If you've got any more questions, let me know. If there's anything you think I missed out in this video, again, let me know and I'll make an updated video, or if it's something I can answer in the comments, I will. So if it did help, definitely don't forget to like and subscribe. And that's it. Peace.